Hi everyone, welcome to this week's edition of Midweek Market Update. I'm Ashley Roster of Victory Fiduciary, and it's been a very busy 2 weeks in terms of data and information that's being presented by various entities, which has had a pretty substantial impact on market moves. So that's really what we're going to get into today. So there's been a whole kind of list of financial economic data that investors have been watching. Today, of particular interest, the producer price index came out, and so this was very favorable because what was determined was that the PPI number rose 8% over the month of September, compared to an expected 8.4%. So PPI rose less, which actually is a good thing because that tells us that perhaps inflation is beginning to stall. It also rose 0.2% for the month of October, which was below the 0.4% estimate. And so PPI, or the producer price index, is basically just the what producers domestically are receiving for their goods. And so that is just another metric that we follow. This comes right on the heels of the CPI numbers from last week, or the consumer price index, which those numbers came in yesterday. You've heard us talk here before about that. And so we saw a monthly gain of 0.4%, which again came in less than the 0.6% that was estimated. And then the 7.7% annual gain decelerated from that peak that we hit at 9% in June. And so markets absolutely soared last Thursday coming off of these CPI numbers. Friday, they continued to be substantially higher. Yesterday, we saw markets cool off just a little bit, down about 1%, which really wasn't surprising considering the kind of huge moves we'd made since midweek. And then today, we're kind of right back. We get that PPI number. NASDAQ's up over 2%. Those tech-heavy indexes and those other funds, which again have really been hammered by these inflation numbers, they're all soaring over 2%. And so just kind of an interesting show of how data really does affect the market kind of day to day. So these are numbers, and again, because inflation, which has been really sticky for us for now over a year, remember, inflation directly impacts the ability for companies to be profitable. It affects their bottom line. Price to earning ratios are affected because when it costs you more to ship your goods, to create your goods, to buy what you need to manufacture, and then we look at fuel, we look at all of these things. So high inflation is bad for the books on businesses, that is just that's just how inflation works. And so inflation has been a really has been a concern for this past year, combined with the fact that the Federal Reserve has had to come in and then make all of these fairly aggressive moves in terms of rate hikes to try and quell inflation. And so again, when we talk about the fact that it costs more to borrow money, rent increasing, these types of things also increase a company's bottom line. And so consumers right now, or investors, what they're pricing in right now is that with these favorable inflation numbers, that this may be the tipping point for the Federal Reserve to be able to come back and say that, you know, maybe we can at least slow down these rate hikes that we've been initiating since the beginning of the year. And so that's really what investors are kind of, they're hoping for. That's what they're pricing in. What will the Federal Reserve do with these numbers? We're really still not sure. So investors are really taking a bet right now, though, that the Federal Reserve is going to come back. We say dovish, meaning kind of a little softer, a little less aggressive, a little kinder, if you will. So let's just look at the move that the S&P 500's been making for the past couple of days. And so as you can see, when we talked about here's our 200-day moving average, here's our 50-day moving average. So we had climbed above when we talked last time that we were here. We were above the 50-day. We did wind up coming back below that again, but here we are now. So we have, not only have we kind of cleared the 50-day, had a down day and held that that support, we're now really, we have the 200-day moving average kind of within reach, and so a move to about 4,100 would put us to that next line of resistance. Now you can see the last time we attempted to do that, we bounced off, and then we actually had another steep sell-off, and that occurred back towards August. So it'll be interesting to see what markets can do if we can actually begin to cross through the 200 and then hold that. That would give us a new line of support. And so again, it's been really choppy trading all year long when we look back year to date where we started. And so we've just kind of continue to make lower lows along, and so people keep asking, well, is this it? Is the bottom in? And honestly, I still think it's too early to know. I think that to be able, we finally are starting to get some more reassuring inflation numbers, but I don't know that we can say that inflation is done, that we've officially peaked and then we're coming back down. I think we need a little bit more data on our side. And I also think the one realistic point that we need to be thinking about is that the damage from the Federal Reserve's rate hikes really probably hasn't hit the economy yet. And so I think that could present potentially a little bit more pain down the road. But again, this was kind of step one. We've been saying we need to see inflation finally begin to quell, and then we have to see the Federal Reserve kind of come out and state that they're happy and that they are going to begin to kind of taper back some of these more aggressive rate hike programs. In terms of RSI relative strength, we're at a 59. So we're approaching overbought. We're actually not completely, I would say, overheated at this point. You know, the last time we hit this point here, anytime we get to that 70 mark though, that is definitely a sign that markets will likely pull back. Now, they don't always pull back like this. So this was there was multiple factors that kind of went into why we had this steady sell-off and then just kind of couldn't get it together after that. But I think that if we do hit an RSI of 70, we should expect to at least see a partial pullback for a period of time, because markets, they can't go straight up forever. And we watch this to kind of give us an idea of how overbought or oversold a market is. And so those are things that kind of we look at to trend. And sometimes if investors are considering putting new capital to work, you might not want to put it in to work when you're approaching 70. And again, if you're seeing markets begin to turn and they come from 30 up, that might be a time that you might want to consider. And again, it's not foolproof. It's just a metric that some investors use to kind of determine at least what short term could happen in the market. And so I just want to talk to you, so in case you missed it, we did actually have a midterm election that happened last week. And so it's always interesting to kind of see what markets do. So actually markets have been responding very favorably really all since last week. And so they took the midterm elections kind of all in stride. We've seen positive, strong performance since then. And something that was interesting, so I kind of did some research looking back from 1950 to 2018. When we look at what happens following a midterm, 6 months forward, the return in the S&P 500 is typically 16%. 12 months forward, about 18.6%, and 2 years forward, typically about up 33%. Again, there's a lot of other variables that can go into that, but just kind of interesting. And so what is also fascinating is, so people have been asking, well, what does this mean if we do wind up having a gridlock government, where essentially we have the House and the Senate being controlled by different parties? Is that good or bad for the markets? And believe it or not, a lame duck session for the president, not so good for the president's agenda, but for the stock market, it actually tends to, they respond favorably, because the market knows it's going to be really difficult for those kind of really specific far party lines, whether they're left or right, particularly fiscal and financial policies, will be very difficult to pass in a session where you have split Congress and and House. So that's kind of the idea, that there's not going to be a whole lot of policy work being able to be accomplished in a lame duck session. And so that's kind of what the market is kind of betting on now, that there was not any major sweeps one way or the other, that things kind of are going to remain split. So thought that was interesting. Just coming back in here to look at just inflation, thought this was a good number. So here, or a good chart, we're seeing inflation finally kind of come down from that 9% peak that we saw back over the summer. And we had hit a 41-year high. That was back in June. That was the highest we've been in 41 years. But we still have a ways to go here. So the Federal Reserve is hoping that they can bring us way down. So there's still a lot of work to do. So that's why I say it's difficult to say, okay, that's it, the switch is made, and we're just, on easy street now. I think that there's still going to be some bumps along the road to finally get us to that end point where the Federal Reserve is hoping that we land. And so again, just kind of looking at them in terms of being overbought, oversold, where are we right now. And so we are definitely approaching being more overbought, but certainly not as oversold as we were. So, but we are approaching at least being short-term overbought when we look at kind of some of the moves that we've seen in markets. So interesting enough, I actually just pulled this report today. The S&P 500. So since October 15th to today, November 15th, S&P 500 is up 10.5% month over month, which is a pretty big move. And so just kind of looking to see what areas of strength are we seeing, particularly since these moves. Haven't seen a lot of change. Actually, again, these have been kind of short-term moves. So the value areas continue to still be strong. Growth areas, although growth short-term is where we've seen some of the biggest moves because they had really been pummeled kind of all year long because of these inflation fears. Haven't seen a lot of move. Looking at the sectors, energy, financials has made a move and is now in the number 2 position. Consumer cyclicals has, remember, those are kind of like those staples, those things that you have to buy regardless of situation. We're always going to have to buy toilet paper. We're probably always going to have to go to CVS to buy those areas. But basic materials and industrials have also remained strong. So technology has increased in some buy signals, but again, still pretty far off there to the left. And so I think that with technology, you just need to be really careful, making sure that the areas that you're potentially adding to your portfolio are going to kind of be those long-standing runners over time that maybe for right now it just happened to be kind of on sale and undervalued. And then the laggards being international fixed income and currencies. And so the last chart here, we've been talking all year about the fact that really fear has been driving the market. Fear has been driving a lot of the moves that we've seen. And surely short term, we've kind of seen a real quick switch. And so typically, I like it when we're in this area here. Typically, though, when we get to that extreme greed, that's typically a sign that at least short term, something probably is going to have to change because everybody's on the same side of the boat. And when that happens, typically we see a reversion fairly quickly. So this is actually a contrarian indicator that when everybody is fearful, it's typically the time that you might want to consider, being a little more positive because you'll probably start to see a change. And conversely, if everybody is being greedy, that might be the time that you want to step back and say, what's going on here? Could we be seeing, could we be setting ourselves up for a switch the other direction? But I always like to keep an eye on this. So certainly we've seen an improvement from where we've been because we've been at extreme fear almost all year. So, I just today wanted to be able to get into what these inflation numbers, the impacts that they'd had on the markets, as well as what we've seen in the past with midterm elections. And it'll be interesting to see how that plays out in the future. Obviously, we have a whole lot of different things kind of going on right now. So it'll be interesting to see if those patterns are able to hold up. In the meantime, I would definitely say that if you felt real uncomfortable all year and felt like maybe you took on more risk than you should have, sometimes investors will consider taking these big rallies that we've seen and consider kind of selling out of them, finding a more favorable exit and raising a little bit of cash. Is never wrong. Never wrong to do that if you feel like maybe your time horizon isn't as long as you thought that it was, or again, if you just really felt uncomfortable with some of the moves we've had this year. Markets, these are all part of normal market cycles. Markets can't go straight up forever as much as we wish that they could. And so as investors, it's really important that we kind of have our plan formulated before anything goes wrong or anything goes right. We don't really want to make decisions reactively to kind of just market movements. We kind of always want to have a plan and then be able to kind of stick to that regardless, because emotions have no business in investing, certainly, and it's a very difficult thing to turn off that side when we get into something like what we've had this year. So I thank you for joining us. As always, you can always reach out to me, Ashley R. at victoryfiduciary.com. We're always happy to be able to answer any questions or go over things that you want to discuss. Certainly happy to take a look at your current investment election plan and to make sure that it is set up to meet whatever goals you have. Thank you for joining us, and we look forward to seeing you again real soon. Thanks.